So this thing, this is going to be fun. So what I wanted to do for this piece, I wanted to talk about principal component analysis, which is another way to kind of look at correlations or underlying correlations between variables. But it can offer, I think, like some useful tools for traders that are trying to understand relationships, particularly on large scales with a large number of variables. So I'm going to talk about what this is. I'm going to talk about why we use it, pros, cons, like that kind of stuff. So I don't want to also get like too crazy into the math, because for people who maybe like don't have experience with linear algebra, it's probably not going to be very useful anyway. But I think the actual results we can talk about in an interesting way that do actually have applications for traders, particularly with data visualization, which is what we're going to be mostly focused on using in this context. But just to recap. So on Tuesday, we talked about the limitations of correlation when applied to large data sets. So here I have a correlation matrix for a portfolio with a decent number of elements. There's actually about 30 elements in here. So it is a little bit daunting. Each one of these like little cells tells you about a correlation between a pair of variables. And when we try to use this to measure relationships on large scales, we can run into problems interpreting this data in an intuitive way, in a way such that we can make decisions easily. And so that kind of motivates why we might want to use PCA. But first, I want to talk about a little bit why this is as much of a problem or as much of a limitation as it actually is. So if we zoom out a little bit, recall that the point of what we're trying to do and what we talked about last week and why we, in order to diversify, we need to measure relationships between different variables. And when we look at like historical relationships, a lot of the times when we're looking at it from a two-dimensional perspective, like for example, if we want to look at SPY and QQQ returns and we want to understand when one moves, how does the other tend to move alongside it, we might see something like this. So here I have a plot of SPY returns versus QQQ returns from 2020 to 2021. And we can see this nice like linear relationship. When one goes down, the other tends to go down. When one goes up, the other tends to go up. Very clear, easy to understand relationship that tells you sort of like what we can expect if we have volatility in the future, if we have these two assets in our portfolio. When we have two elements, it's fairly easy. But if we want to, for instance, look at three elements, so SPY, QQQ, and TLT, now our plot is three-dimensional. So we're looking at QQQ return or SPY returns versus QQQ returns versus TLT returns. And now we can see like this kind of three-dimensional surface, and we can kind of get a sense of how one moves relative to the other. But overall, our ability to understand this data, and especially our ability to act on it or make decisions with it, starts to become more complicated. And now if we want to throw GLD into the mix, do you know what that plot looks like? I have no idea what it looks like. It's four-dimensional. I don't know what that looks like. I can't visualize that. So when you get into more elements, this ability to like visualize our data by looking at like the data itself starts to become, well, I mean, it's actually impossible to do that in a way that we can interpret. So in order to sort of get around this, we'll represent this data with correlation. So this is like a numeric value that tells you the strength and the direction of that relationship. So when we have SPY and QQQ, easy peasy. We got a 0.91. We know how to read correlation. We understand how to read correlation. We know that 0.191 means that they tend to move in the same direction and with the same magnitude. So when SPY has a big move to the upside, QQQ also tends to have a big move to the upside. We got that strong correlation. We can measure that easily. If we now look at SPY, QQQ, and TLT, again, we don't have to deal with this gross three-dimensional plot. We have this nice correlation matrix that kind of tells you like, okay, so SPY and QQQ tend to be highly correlated, but TLT has a low correlation between these, like low, a little bit negative, which is kind of what you would expect. But in this plot, we can like very clearly see where that concentration is and how TLT can add a little bit of diversification because its moves are uncorrelated, right? And then if we throw GLD into the mix now, we can again see the relationships between SPY, QQQ, TLT, and GLD in our nice matrix. And here we can see that GLD and TLT might have a little bit of strong correlation, like 0.29, so a little bit of positive correlation. But overall, we can observe that these elements are adding diversification to our portfolio with SPY and QQQ in it, right? Make sense?
Yes.
But now we have this problem where what if we have 30 elements in a portfolio? So, which is like not an unreasonable number of elements to consider if you're dealing with a big portfolio, right? So if I look at this plot and I try to assess where my directional risk is, where my concentration risk is, that becomes difficult. What if I want to take 2 or 3 elements out and swap them out with different elements? Like maybe I want to take Microsoft out and replace it with something else. How does that affect the overall historical risk profile of the portfolio, right? Correlation doesn't provide a straightforward answer to this question because when we deal with large scales, so like large number of elements, a large number of variables, we get something called combinatorial explosion, which is wonderful. But combinatorial explosion is a colloquial term. So this is basically, it discusses, so in this context, when we're talking about portfolios, with each element that we add to the portfolio, the number of pairs in the portfolio grows rapidly. And remember that we're using correlation to measure these different pairs, like the relationships between 2 different elements. So when we have 2 elements, like let's just say we have SPY and QQQ in our portfolio, there's only 1 pair. So we only need to measure one of those relationships. When we have 3 elements, we have 3 pairs, right? This is pairing them different up. We're measuring 3 different relationships. If we have 4 elements, we have 6 pairs. If we have 15 elements, we have 105 pairs. So now if we have a portfolio with 15 elements in it, we have to look at 105 different relationships and how they're all connected to one another in order to make decisions, in order to figure out how to diversify. If we get up to 30, we have 435 pairs. So this is what we call combinatorial explosion. It's kind of, like kind of a more colloquial term, but this scaling makes it difficult to sort of make decisions and assessments when we're looking at these different pairs as we start to scale up the number of variables we're actually looking at. Make sense?
Makes sense, yeah.
Okay, so one application of dimensionality reduction, and I can't even begin to state like how many applications this has and how important it is, especially with respect to like machine learning. But one example of how we can use it is to visualize these returns data in a way that's much easier to interpret while still preserving most of the information in the underlying data set itself. And that's kind of like what the next couple of slides are going to be focusing on. Yes?
Yes.
Okay, so the next couple of slides are going to be a little heavy, but hopefully we'll have some visuals, we'll have a couple of graphics that'll kind of at least give you an intuition on exactly what's happening and an intuition on how to actually interpret PCA plots, which is ultimately what we're going to be looking at. But just to kind of like define dimensionality reduction, it's the process of transforming data from a high dimensional space into a lower dimensional space, while ideally preserving as much meaningful information from the original data set as possible. And we'll talk a little bit on what preserving information actually means, or how we're going to define meaningful information in this context. And dimensionality reduction, it's not only used to improve model performance, especially when you're working with very large, complex data sets, but also for data visualization and pre-processing/noise reduction. We're going to be focusing mostly on data visualization. But this, again, has like a ton of applications in computer science, especially in machine learning. This is like really core process for sure. Yes?
Yes.
Okay, so principal component analysis is, I think it is like the most common linear dimensionality reduction techniques, but I don't like to talk in absolutes. But it's extremely common linear dimensionality reduction technique. And we use it to identify underlying correlations between a large number of variables. And we do that by isolating what's called the principal components of the data set. And technically what that is you have orthogonal or uncorrelated components that retain the variation of the original variables or the original data set. That probably doesn't make a ton of sense, but hopefully after a couple of visuals that will make a little bit more sense on exactly what we're trying to capture with these principal components and why that can help with our issue of visualizing some of this data. Yes?
Yes.
Cool. So I don't want to go deeply into the math because I don't think there's a lot of utility into it. And you'll also probably get an explanation of the math from people that are much better than myself at explaining it. But I kind of wanted to show sort of on a higher level what's happening to the data. And we start by standardizing the data. So we want to look at this like a simple case in order to build some intuition around this. But let's start with QQQ and SPY. So we have our 2 different variables. We have the 1 pair, and we're trying to, again, measure the relationship between these 2 different assets, the returns of these 2 different assets. And so the first thing that we're going to do is we're going to standardize our data set. What that means is that we're going to orient it around the origin so that we have like a standardized, what would you call that? A standardized frame of reference, I guess you could call it. Make sense?
Makes sense.
Now, this is where it gets a little complicado, but when we find the first principal component, remember that what we're trying to do is we're trying to find vectors that capture a certain amount of information about the data set. And in this context, the information is going to be the variability of the data or the variation of the data. So when we look for this first principal component, basically what we're trying to do is we're trying to draw a line that cuts through the data such that if we take all of the data points and project it onto that line, the variation of the data along that line is going to be maximum. So we can see that there's a bunch of different lines that we can draw. And when we project the data onto that line, there's only one line that will give you the maximum variance, the maximum amount of information in that data set. Does that make sense?
Yes.
Easy. See how easy that is? And in the 2D case, it's hopefully like easy to visualize exactly what that means, where we're projecting our data and we're trying to find a line such that the variation of that data is actually maximal, which kind of encompasses the information that we care about in this underlying data, right? Make sense?
Yep.
So when we find our first principal component, in the 2D case, it's actually very simple what we do next. But when you're dealing with a multi-dimensional case, there's some optimization that goes into this. But once we have our first principal component, remember, this is like a line that we've drawn through our data that encompasses most of the variation of that underlying data. Once we have that line, we're trying to find an uncorrelated or an orthogonal vector relative to that line that will encompass more variability in that data that's unrelated to the original variability that we've already captured. So mechanically, what that looks like is that we have our first principal component and we find a perpendicular line, like an orthogonal line to that first one that we drew, such that when we project the data onto that line, variation that's uncorrelated to the original variation is going to be captured. Does that kind of make sense?
Makes sense.
The 2D case is very easy. The 2D case, you just find the perpendicular line. When you're dealing with a 3D, a 4D, a 5D, whatever case, there's going to be more the mechanics around how you actually find this line. But in the 2D case, it's pretty straightforward. You just find the perpendicular line, you project the data onto that second line, and boom, you have your second principal component. So these two lines, these two principal components, the first one, which captures a lot of variability, the second one, which captures less variability, is ultimately going to be our new coordinate system that we're going to map our data onto in hopefully a simpler way. And so what we're effectively doing is we're creating a coordinate system where the different axes are sort of ranked based on how much information from the original data they actually capture. Does that make sense?
Yeah.
So distances across each principal component are going to mean something different. Since our first principal component captured most of the variability, a very large portion of the variability in our data, distances along that axis are going to mean a lot more than distances across the other axis. But having both of them in there still allows us to, capture, information from the original data set. So minimize the amount of data that we're losing during this transformation. Does that make sense?
Makes sense.
See how easy it is.
You're good explainer, Julia. Definitely.
We're definitely like, I took all of the math out of it, or not all the math, but like I took like the actual mechanics of the equations out of it. The mechanics behind how this is done is actually really interesting. So if anybody actually like is into linear algebra, is into data analysis, definitely check this process out if you haven't already. It's really cool what's going on here and really important when you're dealing with data science or machine learning or anything like that. But effectively what we're doing here is we're looking for these two vectors that capture information about the data. And now we're going to map our data onto this new coordinate system. So we take, in the example of the 2D case, we have our SPI returns, our QQQ returns, which can also be represented with that correlation matrix. And when we map it onto our new coordinate system, where each axis represents one of our principal components, you have SPI on one side and QQQ on the other side. So we've taken these dots, like all these returns data, we've taken this correlation matrix, and we've now plotted them into a new visualization where each axis now contains a certain amount of information about our original data set, right? Make sense? And with each principal component, so you have your principal component axis 1, that captures 97% of your variability. And then principal component axis 2 is 3%. So you can see how, again, since one principal component captured significantly more information about our data set, our original data set, distances across that axis are going to be much more than distances across the other axis. And you can actually calculate how much variation or how much information is captured by each principal component, which is super cool. Make sense?
Yeah.
So in our 3D case, we don't need a 3D graphic anymore. We don't need a correlation table anymore. We got our principal component data. So as a way to sort of visualize this, you can see how like SPI and QQQ are kind of clustered together. It shows the similarity in the data according to their principal components. And you can see that now TLT is kind of like off in the lower right-hand corner. And this is, again, how we're trying to capture as much of that information about these underlying correlations, but visualize it in a way that makes a little bit more intuitive sense. Make sense?
Yeah, the thing looks way better than the 4D model.
Easy
3D,
peasy.
sorry, 3D model.
Easy peasy. Well, the 3D model is like, yeah, it's once we get to 4D, like the models are out the window. But again, you can see how the principal component, the first principal component axis, like it captures 85% of that variability, of that variation of that information. And then the other one captures 13%. So we're losing a little bit of information, the more, elements that we get. That's not necessarily a bad thing. I'll talk about that in a little bit. But either way, the visualization tool is significantly easier to understand when you're actually looking at this different type of plot, right?
Yeah, for sure. Looks easier to, once you understand it, to get a grasp of it on the right side.
Exactly. So this can, again, I think it helps to understand like how these axes were put together. Once you get to a multi-dimensional case beyond like, 3 dimensions, whatever, then it gets a little bit more confusing. But in our goofy dimensional case or a 30 dimensional case, we can now create a figure that looks a little bit more like this. And again, we can see how different components are clustered together based on how really similar or how correlated their risk profiles are. Except now we can hopefully see the information a little bit more clearly, if that makes sense.
Yeah.
So we have our principal component axis 1 that encompasses 51% of our variation. And then principal component axis 2 encompasses 13% of our variability. So we're losing a lot of information when we make this transformation. That doesn't necessarily mean, that's not necessarily a bad thing, because like there's a lot of noise in financial data, but you still do need to be mindful of the amount of information that's actually lost when you undergo this, right?
Yeah.
But either way, with the visualization, you can kind of see things hopefully a little bit more clearly. So you have like GDX and GDXJ, they're kind of like outside. So you can see how you have some of these components along the outside. You have TLT, you got GLD, you got Walmart and Amazon and AMD and Tesla, and that kind of, and then GDX, GDXJ. That kind of shows you that like some of these components can add sort of like more diversification than some of the components that are sort of more closely clustered together in this PCA plot, which is exactly what you would expect, right? And then inside some of these clusters, so for example, like the kind of the dark orange one, you got XLV, J&J, PFE, and then FXI. And so some of these biotech companies and some of these pharmaceutical companies, healthcare companies are clustering together. In this sort of red one, you have SPY, XBI, SMH, Google, Microsoft, Apple, McDonald's, and then the Qs. So some more tech heavy exposure in there. Inside of this purple one, you got USO, IWM, Verizon, and MasterCard. They're kind of clustered together. And then kind of like up towards the front, you have XLE, Wells Fargo, Bank of America, JP Morgan, and then CVX. So with this visualization, you can kind of see like, okay, so some of these elements, at least historically, have given me a similar kind of exposure. Whereas if you were to look at the correlation matrix, you wouldn't be able to see that very clearly. You'd be able to look, if you knew where the clusters were, but being able to see the clusters originally would be kind of difficult. And so that's why we sort of use this tool to kind of, even though we're losing information when we undergo this transformation, it can still kind of tell you what elements are sort of giving you a similar risk profile, at least from a historical perspective. Does that make sense?
Makes sense, yeah.
And again, you have to keep all the caveats in mind, and especially when it comes to like the amount of data that you lose and that you don't have a clear understanding. Like it might not all be noise, it might be signal, and that's not necessarily a good thing either. But I think from the perspective of like practical decision making, having different visualization tools, even if you do lose some information along the way, I think is pretty important. So I guess sort of to conclude, Dimensionality reduction involves mapping high dimensional data to a lower dimensional space, and principal component analysis achieves this by identifying the principal components in the original data set, or the orthogonal vectors that capture the variance of the original data. PCA can enable traders to easily identify correlated portfolio components, even when working with a large number of variables. And I just wanted to give a little teaser because this is kind of something I want to talk about for next week, but in this plot that we saw on the previous slide, you can see that the different PCA components are clustered together, where you kind of have, the yellow ones are kind of clustered together, red ones are kind of clustered together. And you can see that they can actually be identified according to which ones are in the closest proximity to one another. I want to know, or we're going to find out, I guess, is there a way that you can automate this process? Is there a learning protocol that you can use to identify these clusters when you don't exactly know what kind of data to expect, if that makes sense?
Makes sense. That will be pretty interesting to see.
But that's all I wanted to talk about. I hope you guys found that interesting. I hope the math was not math, but was pretty straightforward. But I hope the explanation of these sort of underlying mechanisms was pretty straightforward.